Everyone can see my screen? I think so.
Yes.
Okay. And so I'm going to kind of piggyback off what Adrian just said, and it's how do you finance these damages done by an earthquake? A lot of people think of insurance, and insurance is, the foundational layer of rebuilding, but there is other ways capital will come to us after an earthquake. So what we can do in terms of insurance is we can buy community-wide insurance. Now we know in California, roughly 15% of communities are purchasing earthquake insurance, full coverage or partial coverage. And a lot of communities are buying no coverage, unfortunately. And so when you're not buying coverage at the association level, that trickles down to unit owners. And that means these individuals in your communities, your members need assessment insurance. So anything you don't buy at the board level becomes an assessment. And as Dr. Lucy Jones mentioned, there is things we can do to mitigate, retrofit, kind of minimize the damages that would occur. And that can be done at the community level or the individual level as well. And then after an earthquake, we just mentioned, Adrian mentioned, is there is capital that'll come to us, and that'll be through large special assessments. And so the unit owners that have insurance can have help with that, or they'll have to come up with the money themselves. And then borrowing it's an important topic that I'll touch on. It's something that boards don't really think about. I'm a big proponent of large deductibles, and I'll get to why, and it's because of borrowing. And right now, I think everybody in California, the communities that are here that we've invited, know this firsthand. We are in one of the hardest markets, the catastrophic markets, in the last 50 years. Earthquake rates have been going up for 5-6 years in a row, and it's baffling to everybody in California because we haven't had an earthquake. We know our carriers are not paying claims. So what's happening? Well, it started in 2017. We had this really bad modeling that came out. And I think Dr. Lucy Jones may even be responsible for this, so we can get mad at her. But in 2017, the scientist down at the California Institute of Technology basically said, we're less likely to have this, Northridge earthquake over the next 40 years, but we're more likely to have an earthquake that's a 7.5, like 16 times greater than Northridge. And that really scared a lot of carriers, especially up towards the Hayward Fault. And we're not dealing with the East Bay, but, and what happened is rates started getting more and more expensive. And then we couple that with one of the worst 10-year runs in catastrophic claims that we've had in the U.S. market. And these were wind losses, flood losses, the Texas ice freeze. And even though our reinsurers weren't paying claims for earthquake in California, they were losing a lot of money throughout the country, because at the end of the day, these reinsurers, if they lose money in Florida, that hurts us in California. And to show you how unhealthy this insurance market has gotten in the United States, and in a healthy insurance market, about 1% to 2% of premiums will go through these excess, surplus, non-admitted carriers. Today in the United States, over 10% of all insurance is placed in these excess markets. And that just shows you that we are in a really unhealthy insurance market in the United States. And so when it comes to insurance options for boards and unit owners, first you have this master earthquake policy that you could buy. And these are obviously the best if you can afford them. Full coverage, you're basically guaranteeing your association is going to be able to rebuild through enough capital through that insurance policy. Unfortunately, in California, probably less than 1% of communities buy full coverage. Now, the majority of the associations that do buy earthquake coverage usually buy partial coverage. They'll usually use a probable maximum loss statement, which says something along the lines, in the next 250 years, if there's an earthquake, what's the most damage that the insurance companies are expecting? And so if your total insurable value of your association is 100 million, that probable maximum loss statement may say, in the worst event over the next 250 years, you can expect $25 million of damage. So boards are buying these partial coverage options because in reality, it's the only thing they can afford. And so if you're buying partial coverage, like a lot of the communities that are here today, you just have to understand, when you buy partial coverage, that's great. You're doing more than most communities. You're putting your association in a wonderful spot to rebuild, but we still do need to educate our members that it's not full coverage, because anything we don't buy becomes an assessment. And then there's a third, option that obviously everybody knows about today, and that's this custom master opt-in program, which is built for individuals to buy custom assessment insurance, which uses granular underwriting, doesn't depend on zip code underwriting, allows your membership to buy full coverage without crazy exclusions at a fraction of the price. And then I just touched upon this, and Adrian Adams talked about it. Why is special assessment insurance so important for these common interest developments? It's because in your association governing documents will say something to this effect. It's that if your HOA is underinsured or uninsured, all unit owners will be equally responsible for earthquake damages. So even if your building's not damaged, you're going to pay the same amount as the people living in the damaged units when it comes to rebuilding. And the reason why is when your CC&Rs were drafted, it's going to be in the spirit of, well, if we don't buy earthquake insurance, all members are benefiting because the HOA dues are lower. So that means if you have this assessment, you need assessment coverage that covers all common areas, all non-residential structures, all residential buildings, most likely unit interiors, foundations, underground pipes. So if you're living in one of these communities, you have this really broad earthquake exposure, and that's called assessment coverage. I added this slide quickly because I want to talk about it. It's really, really important. And I get really frustrated when people are just too reliant on probable maximum loss statements, and they're great. Or structural engineers come in and say, you know what, this building, only 20% will be damaged. That structural engineer is right. But what that structural engineer is not telling you is earthquake, and this is what I always tell all my boards, earthquake damages occur in two waves. You have the earthquake wave. And yes, that earthquake, as we're looking at a picture from a Christchurch building, that earthquake may only damage 20% of your building, but that doesn't mean 100% of it doesn't have to be replaced. Because what happens is you have the earthquake, and we're looking at this picture, about 10 or 20% of the building was damaged. Then a city engineer comes in and goes, you know what? I know only 20% was damaged, so boom, the probable maximum loss was right. But as a city engineer, they have to make the decision, were these foundations jeopardized? Are we going to allow you just to rebuild the 10% that was damaged? Usually they say no, and they red tag it, and they say, you know what, knock down the other 90% that wasn't damaged and start from scratch. So if you become too reliant on people saying only 20% will be damaged, you're forgetting that city engineers do most of the damage, because they're going to come in and say, nope, knock it all down, rebuild from scratch. And so when you buy partial coverage, this is why it's so important that you go to your membership. We're buying as much as we can, but you need to know that you still could be facing total damages, because city engineers could come in and say, rebuild everything, and it will happen. Because as Dr. Lucy Jones said, for every one building that gets knocked down or fully just collapses totally, 9 more get red tagged. And so these red tagged are where you really need contingent liability insurance, coverages for demolition, coverages for the undamaged portions of these buildings that have to get knocked down because of city engineers. Our product offers all this, our competing products on the individual side actually don't cover demolition and the undamaged portion, which are really bad exclusions. And so here's one of the communities that's actually joining today. And I just want to show communities, because there's a lot of board members that are here that are not a part of the communities enrolling today, on how to kind of do this simple math equation on, what should we be relaying to our membership. So here's one of our communities that are joining, Huntington Landmark. They have roughly 1,200 units. Their total insurable value, this is something we work with your retail agent to come up with a value on the reconstruction for your entire association, is roughly $280 million. Now, they purchase a bunch of coverage, a lot more coverage than most communities buy in California. They bought $60 million of coverage. Now, as you'll see, 60 million minus 280 million, and they still have roughly 230 million of uninsured exposure. So how do we come up with what everybody's special assessment exposure is? Well, it's simple. You take that 227 million, you divide it by the number of units, and we know everybody has an assessment exposure from earthquakes of roughly $184,000. So if you're on a board, you should always be doing this simple calculation and letting your unit owners know how much assessment insurance they should be buying. Now, before we came along at Modus, you couldn't buy $184,000 of assessment coverage. And here's the benefits of our individual program. We have the granularity of our underwriting where we can say, oh, Huntington Landmark, you have a $60 million master earthquake policy. Well, let's give you some credit for that. Let's give you excess pricing. So we are taking advantage that your board's buying some coverage. Well, that's going to make it cheaper for your unit owners. We're the only program that can do that in California. Now, our competitors use zip code rates. Well, that's not very good. That means, and Dr. Lucy Jones will lose her mind here, that means that people living in a certain zip code, doesn't matter if you're reinforced masonry, soft story parking, or fire resistant brand new construction, everyone gets the same rate. Well, we don't do that anymore. We'll give you a rate based off your exact community. If you have garden style HOA homes with, first story, have underneath your parking garages or attached parking garage, we'll take the actual risk and characteristics of your association and give you a rate for your exact association. And for 99% of the time, that means you're going to save money because the more we know, the better we know. And if we can apply a rate based off your exact characteristics, it's going to save your community money. As you just saw, we can offer full loss assessment coverage, and we're going to give you these coverages. As you'll see that your unit owners couldn't get on their own. They couldn't get coverages for common areas. They couldn't get coverage for ordinance and law A and B. They didn't have combined assessment coverage in unit interior. They didn't have this broad language that we can now offer your unit owners. That way they can say, you know what, if I buy $180,000 of coverage from Dan, I can use it at $180,000 however I need, because it's really hard to know what you'll need, whether it be assessment coverage or coverage for your unit interiors. And now for the folks from Huntington Landmark, this is what we were able to offer them. We were able to factor in that they had a master policy. We were able to do the granularity of our underwriting based off their exact association. So when we're compared versus the California Earthquake Authority, you can see that the California Earthquake Authority is very limited in what they can offer, only $100,000, very expensive for that $100,000. And then they start excluding things that you need, common areas. They don't cover all parking garages. They don't cover all the foundations. They don't cover utilities and underground plumbing. They don't give you the full coverage for ordinance and law, demolition, and coverage A, undamaged portion. They don't include in their $100,000 coverage for unit interiors, and they don't have a broad provision for guaranteed cash if the HOA doesn't rebuild. They'll give you some actual cash value, but it's very narrow language. The damage has to be to your structure. Now, but your insurable interest is in common areas in all residential buildings. So, that's not a very good actual cash, guaranteed cash provision that the government offers you. So Huntington Landmark, this is now what we can offer you. We can offer you more than $180,000 of coverage if you have a bigger unit, you have nicer improvements, and we can offer it at a fraction of the rate without the exclusions of what your membership had available to them in the past. And why this is great for the board is more people will buy. If it's more affordable, it makes more sense, more people will buy. Here's another community, I think that's here today. This is in the desert. So I wanted different boards to see that it's not always as cheap as it is for Huntington Landmark. Here we are in the desert, a very high risk area. I think this is Palm Desert, Monterey Country Club. Now they had a much smaller master policy, but we were still able to give them credit for that master policy. And then we used, our underwriting based off their exact community. And we were able to, again, save all their members money if they wanted to buy coverage. Now, it's only $300 a year, but $300 a year is a lot, especially when you realize that we don't have those exclusions versus what was available to their membership before we arrived. So Monterey Country Club, just like Huntington Landmark, said, we bought a little earthquake coverage, but we certainly want to make sure we, allow our membership an additional option. It doesn't take away from the California Earthquake Authority or other individual options out there. This is just additive. If you still want to buy from the California Earthquake Authority, if you still want to buy from GeoVera, you can. But Modus is going to come in and they're going to offer you this custom product, help you sign up, give you the best advice possible, whether partial coverage makes sense, or if you want to buy more coverage and how to sign up. And then what I really love that Adrian Adams mentioned is borrowing. And a lot of the communities that are reaching out or on this call today, I am a big proponent of large deductibles because I know people are so obsessed with large special assessments and those will happen. But we are going to have an influx of capital from private and federal lenders. The SBA, is a powerful tool. And the biggest thing with the SBA is it's first come, first serve. So when Adrian Adams says, get your ducks in a row at the board level, get the ability to have the ability to apply for an SBA loan after a catastrophic event without a membership vote. Because if you don't get that approved now, if you need a membership vote just to apply for an SBA loan after an earthquake, guess what? It's too late. And why you need that SBA loan is because it's amazing. It's a 30-year term. I think it's interest-free for 2 years and 3% for the next 28 years. Well, that saves you millions of dollars in interest. And why this is so wonderful for communities is everything you can borrow, it increases your monthly dues moving forward. So let me give you a little example of why borrowing is so helpful. I always say you can borrow about 15% of the community's total insurable value. And so let's take an association with 30 million in rebuilding costs, 150 units. So you get your $2 million SBA loan because we applied on time. For 150 units, that's about $8,500 a month, 30-year term. That increases everyone's dues by $57 a month. Not bad for the first $2 million of damages. Then let's say we get a private loan for $3 million, $21,000 a month, 20-year term, 6% interest. That increases your dues another $140 a month. So for this community, for the first 15% in damages or $5 million in damages, we're only increasing our dues by $197 a month. That's not bad. If you went to that community and said, do you want to pay the first $5 million with a large special assessment where we can increase your dues by $197, they're gonna be like, $197 isn't bad. We can live with that. So remember that when you're purchasing an earthquake policy, or remember that on your personal side. When we come to you and say, feel comfortable with the 20% deductible, this is why. You're going to be able to apply for SBA individual loans as well. And so loans are powerful, and loans, if properly guided, should make you feel comfortable buying a more affordable insurance product with a larger deductible, in my opinion. And that's it. So I talked quickly as I always do. I see everyone left during my talk, which is also pretty common. But let me see, do we have any questions for any of our panelists? You mentioned Modus is a program manager. Okay, yes, we're a program manager. What that means is our carriers are the largest A-rated commercial carriers in California. Insurance Company of the West is one of them. I believe they are the #1 rated admitted California commercial carrier in the country right now. They have an A rating. We have Palomar, who's a publicly traded A-rated admitted carrier. We have Aegis, another admitted carrier, and then we have Beasley and a couple of Lloyd's products that we are the program manager for. We are basically responsible for the marketing. We make relationships with your retail agents and handle some of the policy administration. Modus will not be paying your claims. It's these wonderful admitted A-rated carriers who will pay for your claims. Okay, let's see. Dr. Jones, can you comment on possible liquefaction? Thank you. That's so wonderful. Such a great reader. Impacts the Coachella La Quinta area, and what is the max probable earthquake for San Andreas? Oh, she has this one.
Yeah, the maximum probable earthquake for the San Andreas. Depends on what you mean by probable. And the question really is how long a section of the fault goes at once. We debate, the biggest one would be what we call the wall-to-wall rupture, for obvious reasons probably, running all the way from the Salton Sea up to Paso Robles. The reason we stop at Paso Robles is the San Andreas changes character there, has lots of small earthquakes, doesn't seem to have big ones. And that would be an 8.2. That happens versus one that's only 7.8 that stops, say, at Lake Elizabeth, the shaking in Coachella Valley won't be any different. There's still the same thing happening in Coachella Valley. So it's only how much larger an area is associated with it. We studied this earthquake in what's called the shakeout scenario. Those were those pictures I showed you. And we specifically looked at liquefaction issues. And to get liquefaction, you need both sandy soil, which sort of defines the Coachella Valley, but you also need a high water table. It needs to be saturated. And so the good thing about a drought is it has really drawn down our water table across Southern California and reduces the liquefaction risk. When we modeled it, it was really only down around Indio If you want, if you look for the shakeout scenario online, you can get a map showing the distribution of expected liquefaction. So probably it won't be too bad. You can get what are called ground failure, which is basically liquefaction without water. It's not as damaging, but it will be disruptive. So it's Northern California has a much bigger liquefaction risk because their water table's higher.
Now, there are a couple quick questions from the one panelist to another. Lucy, one of the big things I always try to tell some of our communities is we actually, unless you were alive and well, really in 1906, which I don't think many people were, was we really only experienced a moderate earthquake. Right. And those earthquakes, 94 and 89, were actually really short. I think they were only 40 seconds of shaking.
Oh, less than that. Yeah. 89 was 15 seconds and Northridge was 7 seconds. And 1906 was probably about 120 seconds or 100 seconds because it did rupture. Right? If you rupture in only one direction, it's basically 2 miles a second. So if you got a 100-mile long fault, you'd have 50 seconds, but sometimes the rupture starts in the middle, which is what happened in 89. So yeah, these just aren't that big earthquake, but the intensity of the shaking in Chatsworth during the Northridge earthquake is about as bad as it's going to get at the frequencies that most buildings respond to. The really big buildings respond to longer frequencies or longer periods, longer wavelengths, and we get more of those in the biggest earthquakes. The difference in the really big earthquake is how many more people are suffering from it, which both means your resources are strained that much more. Of course, it does mean you tend to get more of a response and more government help coming in. But the magnitudes differ by the scale at which things happen. And the fire following earthquake is a really big issue. And when you get to your biggest earthquakes in an urban environment, it grows exponentially. And our estimate for shakeout was that the fire after the earthquake would double the losses.
And do you have another one quick question from another panelist? So California, we have these slip strike faults versus what we saw in Tokyo with subduction zones. Would you say a particular type of building, let's say a small 3 to 4 story wood frame building in California, is more vulnerable than a high rise in California, or does that really not matter?
Okay, so the strike slip versus subduction, that's what the fault is moving. It really doesn't have a lot to do with the shaking. You still get the same distribution of shaking just because you moved in a different way. So the big subduction zones are bigger. There's more long period energy. It lasts longer, but they're also farther away from you because they're out under the ocean, right? The San Andreas will cause more damage. 7.8 on the San Andreas is probably more damage than the magnitude 9 on the subduction zone off of the Pacific Northwest because it runs through our backyard. And that idea that the shaking dies off with distance really quickly and how close you are makes a difference. The type of building gets affected by the frequency of the shaking. So the bigger the earthquake, the more rolling motions that you get. And your little single family home just bobs on top of the ocean, doesn't really matter. Even 3 or 4 stories. We estimate about 10 stories gives you 1 second of peak shaking. So a 50-story building is going to really respond to 5-second energy, whereas a 1-story building responds to 10 hertz. And a magnitude 6 peaks out around 3 hertz, 2 hertz. It's only when you get to the 8s that you get the energy that really affects the big buildings. That's the big difference, is in magnitude.
Hey, Dan, I've got a question for Dr. Jones. When is the next big one going to hit and where?
And if I could tell you that, I would be a lot richer than I am. Right? The San Andreas is the single most likely source in the continental US. That said, it's somewhere between 1% and 2% chance per year. Right? We used to say 1% chance a year. That study that you referred to, Dan, that came out in 2017, Caltech had nothing to do with it. It was the US Geological Survey and the California Earthquake Authority. I mean, lots of experts from lots of places. And yeah, you get rid of 6s, if you take the same energy and release it in 1.8, you get rid of 50 magnitude 6s, or 1,000 magnitude sixes, 50 Northridge size earthquakes. And so your overall risk goes down, but you have it more concentrated in bigger events is what's going on there. And, you know, we went from 2%, saying 2% a year for the San Andreas to maybe 1.5% per year in that study, sort of trying to figure out how the different earthquakes connect, but it's low in any one event. And therefore the next one is probably not the San Andreas just because there's so many other choices.
We got one great question, and so I'm just going to have this be the last question because I know a lot of our team members are going to start in town halls. And Dr. Lucy Jones, this is going to be towards Adrian Adams, so we're going to let Dr. Lucy Jones speak.
I need to run off to my next event. Thank you very much.
All right, thank you. And now, Adrian, here's a question we always get, and it's and I'll answer part of it to the insurance part. Is there always a question is why should I buy insurance if my neighbor doesn't? Won't unit owners walk away? And, you know, I guess where the question goes is, how does the HOA rebuild if you have people walking away from their homes? And I guess because you were around with Northridge, you saw these communities.
Right,
rebuild.
I dealt with Northridge, and that's why it's important to have insurance, because it reduces the risk that people will walk away. When you don't have insurance, that means large special assessments, and if people don't have very much in the way of equity in their unit, they're more inclined just to walk away, and that puts a greater burden on the ones that stay. So that's why insurance really is important, and we encourage our clients to get insurance and to keep it. And your program certainly gives an option that previously was not available.
Yeah, and Joe, how I answer this question and the question to I believe someone who asked this question, as I always say it, is I try to deconstruct everyone's thinking. Is there's two types of resiliency. There's HOA resiliency and there's individual resiliency. And I can't promise you your HOA will be resilient. I can tell you the tools they'll have to get capital to rebuild your neighbor who couldn't pay their assessment. You know, if your neighbor doesn't have the liquidity to pay assessment, they have an individual lender they have themselves. Their lender could step in and pay the assessment on their behalf, foreclose on them. The HOA could take out a lien and pay for your unit owner's assessment that walks away. But what I tell all our clients is, if you buy an insurance product or a loss assessment product that's properly with proper provisions, if your association doesn't rebuild, you should be okay yourself. And let me walk you through this. If you buy $500,000 of assessment coverage through us, let's say your home's worth $1 million. Well, the market value of your home comes from two things. It's land value, entitled land value, which is really, really worth a lot of money. And then you have your insurable interest in the improvements on the land, which is the insurance. So if you buy $500,000 of coverage to us and your HOA, for whatever reason, is not rebuilding, they're going to dissolve. If you have an insurance policy where you can buy $500,000 and you know you're going to sell the entitled land because the HOA is dissolving, well, you should get your prorated share of the land sale. Let's say you're $500,000. And then if you buy enough insurance, you should have your, the check from your land and your insurance check to walk away with. You should be okay. You shouldn't be reliant. If you buy a good insurance policy, you should not be relying on your neighbors. You should say to yourself, if the HOA rebuilds, that's great. And if they don't, I'm going to be okay too. So there's two different types of resiliency. We want your HOA to be resilient first and foremost, but you need to know that you can be comfortable if you're not totally handcuffed to your neighbor if you buy a good insurance policy. Okay. Well, with that, let's see. To everybody, we're going to be sending a recording of this and all the slides to everybody that's requested it, and to all the people that came today. And Adrian, I also want to thank you for your time today.
Certainly. Thank you, Dan.
All right. Well, take care, everyone.